In this video, we'll discuss what partnership taxation is and how it can help you. But before we get started, please make sure to like, subscribe, and turn on that notification bell. So what is partnership taxation? Well, for tax purposes, partnerships are classified as pass-through entities, and they're also known as flow-through entities. And what this means is that the entity's taxes pass through onto each owner's individual tax returns. So in other words, all taxes are paid at the individual level and no taxes are paid at the entity level. And this is governed by Subchapter K of the Internal Revenue Code. You use Form 1065 to file partnership taxes, and these then go on to the partner's Schedule K-1s. So what entities can be taxed as partnerships? Well, these entities can be multi-member LLCs, limited partnerships, and general partnerships. And with these entities, the partnership taxation is the default form of taxation for these three entity types. Now, with all of this in mind, what are the benefits of being taxed as a partnership? Well, first and foremost, they're great for passive businesses. And these can include holding title to real estate. And in this situation, you can either have an LLC or a limited partnership. And here, all gains and losses pass through onto the owner's individual tax returns. And the second benefit is the distribution flexibility that this form of taxation offers. And this is because distributions to the partners can be allocated in a manner that's different from the ownership percentage. So as an example, let's say that you have two partners that form an LLC, each of which own 50%. Well, if the entity's taxed as a partnership, as an example, the distributions can be made 80% to one partner and 20% to another. And this can happen when one partner contributes more money or assets to the partnership, or that one partner takes on more risk. However, in order to do this, there are certain IRS rules that apply. And you'll definitely want to double check with your CPA here. And when doing so, you'll want to make sure that you have thorough business accounting records. And you'll also want to have these special allocations spelled out in the partnership agreement or the operating agreement. And partnership taxation differs from entities that are taxed as S-corps. And this is because if you have an entity that's taxed as an S-corp, the distributions must correspond to the ownership percentage. So going back to the example where you have two partners that each own 50% of an LLC, if that LLC is taxed as an S-corp, those distributions must be 50-50 to each partner. So there isn't as much flexibility there. So in conclusion, partnership taxation is the default if you have a business with two or more members. And in some situations, this can come in really handy. But you'll want to double check with a CPA to understand the intricacies of partnership taxation. After all, it's an area of taxation that's extremely complex.